Shibani Sircar joins us now. Let's connect with Shibani and let's take our conversation forward. She, of course, is Executive Vice President and Fund Manager with Kotak Asset Management Company. Shibani, it's a day when you would have said that everything was right for India, right? Crude is down, FIs have started buying, global cues were decent. Yet markets are showing tremendous signs of fatigue. And keep Nifty out of this situation, the breath has been rather poor actually.
Yeah, hi, Nikunj. So, of course, our markets have had a great run. Markets have outperformed the emerging market pack by a mile. But like you rightly pointed out, that if you look at the fundamentals of the market, whether it be in terms of macro or earnings, they are largely where we were and largely stable. There are a few key things that we need to keep in mind for the market. When we look at our earnings trajectory on a YOY basis and you look at quarterly earnings trends, the quarterly earnings trends have come off a bit. And even in the last quarter, while numbers were largely in line with estimates, the estimates itself were muted. Now for FY25, the earnings estimates are still in the range of about 10 to 12%, which means that for the second half of the year, earnings needs to pick up, especially coinciding with the festive season. So there is an expectation of earnings improvement going into the second half of the year, and that needs to play out for our markets. Now, when you look at globally, clearly there are events that are lined up which the markets are watching out for. First and foremost, what happens in terms of the Fed and the September meeting, and whether the Fed embarks on the rate cut cycle. Geopolitical risks remain. And from that construct, when you look at our markets, it's possible that we do see some near-term volatility simply because we have outperformed in a big way. But the fundamental drivers of the market in terms of earnings, macro, and flows remain largely intact. What we have been really saying is that in this market, one has to be mindful of valuations, look at quality companies trading at reasonable valuations rather than chasing momentum, be somewhat overweight on large caps where there is still risk return in your favor from a valuation perspective. And finally, avoid companies which have low free float, where liquidity is low, but where earnings have moved up significantly ahead of, sorry, the valuations have moved up significantly ahead of earnings. So these are pockets which we will keep a close eye on and will avoid certain segments where valuations are looking expensive or stretched.
That's exactly what I wanted to probe about further. What is it that's on your avoid list right now, where there is clearly valuation discomfort?
So when you look at the market in the pockets of large cap, mid cap, and small cap, we've always said that, if you look at large cap from a long term valuation perspective, large caps are trading at a slight premium to their long term history, and therefore that premium seems to be reasonable in context of earnings growth. For mid and small caps, while earnings has been higher than large caps, valuations are also at a significant premium to their own history as well as to large caps. So the way we are approaching the markets is obviously the risk reward seems to be in favor of large caps. Within mid caps and small caps, one has to be extremely stock specific in nature and avoid companies where, again, as we were discussing in the previous question, multiples have re-rated significantly ahead of fundamentals. From a sector perspective, if you look at, and you ask me where valuations are still reasonable, there are two segments where we are keeping a close watch on. One is the consumer space, especially on staples and even some pockets of mass discretionary consumption, where valuations in context of their own history seem to be still reasonable. And there are signs that some amount of demand revival is taking place, especially given the rural and the mass consumption trends on data that we track. The second is on large cap IT, while mid cap IT is clearly trading at multiples which are again fairly expensive with respect to history. Large cap IT multiples, though not significantly cheap, are not extremely expensive either. And the third pocket that we will keep a watch out for is banks, specifically some of the large private sector banks, where valuations are very reasonable as in comparable in context of their return ratio profile and ROE profile. Though near term, the sector does have headwinds in terms of slowing credit growth, margin pressure, as well as some inch up on credit costs. So from a valuation perspective, technology, consumer, and to some extent banks seem to be favorable at this point in time.
Naresh, just to put things in context of the Bank Nifty, I think this is another failed start. Can I say that? Every time it appears that the Bank Nifty is getting ready for a launch, it just fails to have follow-up buying?
So we've not seen more than a couple of days of outperformance of Bank Nifty for a really long time. Day before we saw one of those days where Bank Nifty outperformed, but the next day it flopped out. Right now also it's the same. It's just that it is no more correcting in a major way. And say if you look at the highs, the Nifty is just say 1% away. The Bank Nifty is now almost closer to 4-5% away from an all-time high or even more. Once we sustain above 51,800, that would be an indication. On the downside, 50,000, 50,500 is a support. So it's near the band of total sideways movement. And if you look at the large banks, you hardly see any volatility. If you look at pick up a HDFC bank, look at today's price, and maybe look at 2 months back price, it would be the same. 2 years back, almost the same. 4 years back, almost the same. So eventually, this should catch up. Post-COVID, this is the longest time Nifty Bank has underperformed in the last 10-15 years as such. So at some point of time, we could see a reversal to mean. As of now, would wait for prices to confirm that. But yes, at current levels, banks have underperformed majorly and could actually catch up over the next 6 to 12 months.
Tata Motors, that's been the one stock which is bleeding in trade while the market also is struggling at the session lows. The Nifty alone is down about 0.5% and Tata Motors lower by a good 6%. Why is the stock low? BMW has actually cut their guidance, but what's the linkage between that? Let me take it across to Soumit and understand exactly the same.
Well, Tata Motors remains in focus on the back of a couple of news. Firstly, BMW, which is a luxury car, has given a warning when it comes to the 2024 guidance. They have cut the 2024 guidance for the automotive segment. They have also lowered the margins, and they are saying that China, which remains a key market, they are seeing some muted demand on that front. Now, China also remains a key market and the most profitable market, in fact, for Tata Motors JLR division. So, hence, this could have a negative bearing or a negative impact on Tata Motors as well. Apart from that, UBS has also come out with this note where they have maintained their sell rating on Tata Motors with a target price of close to around 825 rupees, and they are saying that the discounts when it comes to Range Rover has seen a sharp spike in the last few months. They are saying that earlier the discounts were for JLR models were near zero, which has now started to increase because of lower demand. So that is also one of the major concerns coming in for Tata Motors. They are also saying that rising discounts, moderating growth and lack of new hybrid or normal petrol diesel engines could result into a significantly lower financial performance for Tata Motors in FY26. Apart from that, they are also saying that earlier Tata Motors had a good run on the back of new launches. However, that is expected to now slow down going forward. Hence, multiple concerns coming in for Tata Motors, and as you can see, the stock is also down around 5% in trade.
John joins us. Let's take a conversation forward in terms of the technicals and where markets are headed. And Shrikant, what do you make of the current market action? We've spent a lot of time in and around 25,000, almost a month now.
Yeah, I think good afternoon, everyone. Very first, Nifty is consolidating, but at the same time, it is forming some bearish sort of formation at the around near this particular highest point of the rally. So which clearly indicates that there is a good amount of cautious kind of approach from traders. They are not participating in this particular move, and based on technical formation, I think again we can revisit the levels of minimum 24,750, which was the recent low. But while looking at the entire setup of other heavyweight stocks, I am of the view that markets are ready to move towards 24,500 or 24,400 in the near term. So it's a corrective pattern that we can see, but yes, we can see some correction from here.
Shibani, what is your own sense on how you're reading Tata Motors? The fact that BMW revised the guidance, but the price is being paid by Tata Motors today.
Yeah, so if you look at the auto space, our view on the auto sector, and we've been positive on the sector for a while, has been more premised on what's happening at the domestic side of the business, where growth has clearly been one of the key drivers. Now, today, if you look at the entire auto space and you divide it into parts such as the passenger vehicle segment, the two-wheeler, as well as the CV space, our preference at this point in time is for the domestic two-wheeler segment, specifically because of the data trends that seem to point that some amount of revival is in the offing, especially where rural demand is concerned and demand at the bottom of the pyramid or mass consumption, which again benefits the two-wheeler space, specifically in the mass segment. One key factor to watch out for will, of course, be the festive season and how demand pans out. Our thesis is that with monsoons being normal, some amount of government spending coming back on track, the overall wage growth, especially where rural or bottom of the pyramid is concerned, is seeing some amount of recovery, and that is likely to drive demand, both for the passenger vehicle segment, the mass segments, as well as the two-wheeler space. And in this overall construct, of course, the two-wheeler segment appears to be well placed, both in terms of growth outlook as well as valuations. The other icing on the cake for this space will, of course, be commodity prices, which have been benign, which means that at least from a margin perspective, margins should remain largely stable. So I think overall, our view on auto remains fairly positive, primarily based on the domestic demand trends, specifically on the two-wheeler space, and that's how we are positioned in our portfolios.
But is there a case for slowdown in cars, and it's a matter of time? Do you think the four-wheelers will start coming down, Maruti or for that matter Mahindra and Mahindra, because the car sales are no longer even growing in double digit. In fact, they are growing at a rate which is lower than the GDP now.
Yes, so Nikun, so what's been happening in the car space is specifically, post-COVID, there was a significant trend in terms of premiumization. And we saw that the upper end segment and the SUV segment saw significant growth while the mass segment lagged behind and still possibly in terms of numbers lagging behind. Today, if you look at the numbers on volume data, there has been a slowdown and there has also been some amount of inventory build up in the channel, and discounting has also increased specifically on the passenger vehicle space. So that is something that we will watch out for. Our belief is that those players which do have a series of product launches and also players which are present now more in the mass space will possibly be better positioned in the passenger vehicle space, given our thesis that some of the rural demand, the mass segment demand, that demand is coming back. And therefore, this wide gap that you saw in terms of premiumization and the upper end segment growing significantly faster than the mass segment should start to narrow where some of the passenger vehicles are concerned. But by and large, our thesis across has been that with good monsoons, if you look at even the crop sowing pattern, spending by government in terms of post-election spend, the thrust on the rural or bottom of the pyramid should lead to improvement in demand. And of course, the festive season helps in that context as well.
Okay, Shibani, stay with us. On one hand, while you're seeing a cool off in the auto segment led by Tata Motors, similarly, what's actually holding up is paints, given that they're definitely the crude sensitives and beneficiaries today, pretty resilient as opposed to what the rest of the market is doing. Let's try and understand what the cool off in crude really implies for paint companies individually. Samit is here with that data.
Well, if you look at Brent crude prices, they have come off sharply from $85 that we had seen on an average in the first quarter to now below $70 in the second quarter. Now, this will definitely benefit paint given the fact that nearly 40% of the raw material cost is either directly or indirectly related to crude or their derivatives. So, if whenever crude prices fall, the prices of the derivatives also fall. Obviously, there's a lag impact. So, most likely in the second quarter, we won't see the margin benefit coming in for the paint companies, but in Q3 and Q4, if prices continue to remain at a lower level, we'll definitely see the margin benefit kicking in for the paint companies. Now, this is more important for the paint companies given the fact that there was a competitive pricing scenario going on in the industry. So, this drop in crude oil prices will provide them the much wanted relief when it comes to on the margin front, given the fact that they won't have to, their margins could remain more or less on the same level given the fact that raw material prices have come down. So that's more important coming in for the paint companies. Also, what we are understanding is that from channel checks is that the competitive environment is also a bit easing down given the fact that the new player, that is Birla Opus, is not going that aggressive right now in the market. However, the pricing pressure continues in the market, and this drop in crude oil prices will provide the margin relief coming in for the paint companies going forward.
That, in fact, we'll pick up on that discussion on paints, but on the other side of this very quick break.
If you like this video, then like, share and subscribe to ET Now.